Right. Can you see my screen?
Yes, sir, we can see you. It's good.
Right. So last week we actually covered up to this point. So let me continue from this point onwards. So if there are any questions, what we discussed at high level, just to summarize. So we discussed the going concern standard in some examples as well, and then the objective of the auditor, basically to obtain sufficient appropriate audit evidence regarding the appropriateness of management use of going concern assumption in the preparation of the financial statement, and then to conclude based on the audit evidence obtained whether material uncertainty exists. So we will discuss this concept related to events or conditions. So we discussed three types of events or conditions: financial, operational, and others, that may cause significant doubt on the entity's ability to continue as a going concern, and then to report in accordance with its ISA. Right? So, traditional audit procedures when events or conditions are identified. Even the previous slides also we discussed the same. The comfort letters. Now, if you take Sri Lankan Airlines also, the government has given a letter of support. So they have given even, basically guarantees against the loans obtained by the company, where management assumption include. Now, first, management, if there are events or conditions, you need to consider whether there are events or conditions that may cast a significant doubt on the entity's ability to continue as a going concern. As per LKS 1, management has to perform an assessment of the going concern and to conclude whether the financial statements can be prepared on the basis the entity is a going concern. For us, certain entities, it will be a very straightforward exercise, very profitable, having net assets, net current asset positions, substantial cash balance. It's a very straightforward exercise. But a company who is which is having events or conditions in the form of either financial, operational, or others, it may be a detailed piece of work. But as per LKS 1, each and every company, the management has to make an assessment. The extent to which the assessment would be made depends on whether the entity is profitable or not. So when there are events or conditions, management has to make the going concern assessment, which will include internal generation of the cash flows plus the support from the parent entity or a related entity, where management assumptions include assumptions related to the going concern assessment, how they establish the going concern assessment, where management assumption include continued support by third parties, whether through the subordination of loans, commitment to maintain or provide additional funding or guarantees, and such support is important to an entity ability to continue as a going concern. Now, if you see Sri Lankan Airlines, they have plans to increase the revenue and to go for different business cargo operations to expand that business line. In addition to that, cost factors to reduce the cost, salary cut, and then they have even reduce programs to reduce the cost. In on top of these internal programs, they know that with only that they are unable to continue or establish the going concern assumption. Then to support that only, they have, the Sri Lankan airline has letter of support from the government, right? The auditor may consider, or the auditor may need to consider requesting written confirmation, including of terms and conditions from those third parties, and to obtain evidence of their ability to provide such support. So there are two things. If there is a management expect continued financial support, we need to ask for a letter of support from the party who is going to confirm. It may be the related party or the parent company. It could be even immediate or ultimate parent company. Or in the case of Sri Lankan Airlines, it's the regulator, basically the government. Right? and then you cannot just stop it at that point, and you also need to obtain evidence of that entity capacity to provide such support. Even last week I explained one of the companies in one of the export processing zones, so BI zones. So they used to get a letter of support from the parent company, which was based in Germany. But when you see the accounts of that company, they are also making losses. So it's unlikely that that parent company will be able to provide financial support as and when this company requires funding. So in that case, it will not give comfort. Management will be, will not be able to establish that they, despite having even so conditions that may cause significant doubt on the entity ability, still the use of going concern assumption is appropriate unless otherwise they have solid evidence either through internal cash flow generation or through letter of support from the parent or related entities. The first one is you need to obtain the letter of support in written form, and then the auditor has to test, basically get sufficient appropriate audit evidence to confirm the confirming party has the financial capacity to support the entity as and when it is required, right? Or accordingly, the auditor needs to confirm arrangement made with third parties concerning provision of additional finance to support audited entity and the capacity of the third party to provide from his support. Then often a parent entity or another related undertaking will support subsidiary in the financial difficulty. So there are two types of letter. One is the letter of support. That means the parent or the related undertaking agrees to provide financial assistance to subsidiary for a fixed period. The letter of subordination, parent or the subsidiary under the associate undertaking agrees not to demand repayment of financial debts owed by the subsidiary or the entity. So there are amounts payable to the parent entity or basically the confirming party. They say that we would not demand the repayment until such time the entity is in a position to repay. And then the comfort letters could cover even both. Now we certainly for some of our audits we get the support, the parent entity confirm it will continue to provide the financial assistance as and when it is required, at least 12 months. That is foreseeable future mean at least 12 months from the date of these financial statement, and will not demand the repayment of amounts due by the entity to us until such time the entity is in a position to do so, right? Now audit procedures, the audit team could perform in assessing whether the entities are going concern or not. Now in the exam there will be a scenario, right? You will be asked to identify events or condition that may cause significant doubt about the entity ability to continue as a going concern based on the information or the facts given in the scenario. So if you go back, now you will identify, you know, net liability or net current liability position. So based on the scenario, you need to identify. Then fixed term borrowing approaching maturity without realistic prospect of renewal or repayment, or excessive reliance on short-term borrowing to finance the long-term assets. Generally, you need to fund long-term assets with the long-term funding. Then adverse key financial ratios, arrears or discontinuous dividend, inability to pay creditors on due date. So likewise, based on the scenario, you will be asked to identify 4 events or conditions that may cause significant doubt on the entity ability to continue as a going concern, right? Then you will be asked that are required to be performed by the auditor in order to establish. So what is the auditor's objective? Can you remember the objective of the auditor? To obtain sufficient appropriate audit evidence. Sufficient, the quantity, appropriate relevance and reliability, audit evidence regarding the appropriateness of management use of going concern assumption in preparing the financial statement. So first you assess whether the events or conditions that may cause significant doubt about the entity ability to continue as a going concern. Then management has to come up with the going concern assessment with mitigating factors. Now we actually discussed last week what are the how the Sri Lankan Airlines has established the going concern, which means the use of going concern assumption in preparing the financial statement despite having events or conditions, right? So in the exam, there will be, questions, will be a question for you to, based on the scenario, for you to give, draft audit procedures. I mean, you don't want to write all that. This is basically a comprehensive list. If you type about 4 to 5 based on the scenario effect, but make a chakkare padam kalla wage make a padam kalla gilla liyanne epa what. Now this is the overall what you do generally, but based on the case scenario, you have to give what is relevant for that scenario, right? So that is very important. Now this has about, if you take the next slide also, but close to 12 or more than that, I would say, right? At least close to 15 audit procedures. So you have to give only 4 to 5, that is enough. So that sort of a question will carry about 7 marks, right? So going concern in total will go close to 12 to 15 marks. So it's very important standard you need to identify. So these are the some of the audit procedures the audit team could perform in assessing whether the entity is a going concern or not, which means whether the use of going concern assumption in preparing the financial statement is appropriate or not. First, basically, obtain future year's budget and cash flow forecast for the next financial year based on the budgets which have been approved by the board of directors. You need to get that, and then the cash flow forecast for the next financial year approved by the board of directors or an equivalent authority. Assess the assumption for reasonableness and discuss findings with the management. Now first, if you are taking the budget as a basis, then you need to understand what are the the controls, what is the management process of preparing the budgets, what are the controls around it, right? And whether the previous year's prepared budgets are in line with the actuals, whether the budget reflect an realistic prospect. So likewise, assess the assumptions for reasonableness and discuss findings with the management to understand whether budgets and the cash flow forecasts are realistic and achievable, and whether the company will have sufficient funds to meet its liabilities as and when they fall due. I mean, you can come up with the budget way above the expectation, and just to justify use of going concern assumption is appropriate, right? But as the auditor, you need to obtain sufficient appropriate audit evidence. That means quantity, reliability, and relevance. All that you need to consider. If you when you consider sufficient appropriate audit evidence, so you need to understand the budgeting process and whether they have been able to achieve the budgets in the past. What is the deviation and the assumptions? Because this is basically a significant area. How they justify whether the assumptions are realistic, right? Likewise, perform sensitive analysis on budgets and cash flow forecasts by reference to actual results against previous years. Budgets, cash flow forecast, and actual post year. Now, let's say 31st December audit. By the time they do the budget, it would be when you finish the audit, it will be even April, May. So you can see the post year end whether what is the compare the actuals against budgets, right? Obtain the restructuring plan if any approved by the now. This may not be applicable sometimes for your scenario, so don't you should not write this, right? So this is applicable for Sri Lankan Airlines or any other entity, but may not be the case for the case which will be given in your exam. So obtain the restructuring plan if any approved by the board of directors or an equal authority to review how the restructuring would contribute to generate positive results in terms of enhancing revenue and reducing the cost to optimal level. Understand whether restructuring plan, if any, will result in additional liability in the form of VRS. Review the first year in revenue and confirm orders for the future period. Now, if you do now a going concern assessment for an apparel sector company, you will get what is their order book, have they got orders from the buyers, and whether uh, based on the orders confirmed, whether they can achieve budgeted revenue. Review the current loan agreements and correspondence with banks to determine whether covenants have been breached during the under review of post year, right? Obtain copy of the letter of financial support provided by the parent company or related party or any other party who is due to provide such support, right? And assess the financial capacity of the parent or the related undertaking to provide the financial support to the entity as and when it is required. Inquire of the legal representatives as to the existence of pending or threatened litigation or claims, if any, by the creditors, service providers in respect of the company. Perform audit test in relation to subsequent events to identify any terms which might indicate or mitigate the risk of going concern not being appropriate. Review the post year in board minutes to identify any terms which might indicate or mitigate the risk of going concern not being appropriate. Consider whether any additional disclosure as required in IAS 1 in relation to material uncertainties over going concern should be made in the financial statement. Requesting written representation, management letter of representation from management where appropriate from the board of directors or equivalent authority mean audit committee regarding their plans for future actions and the feasibility of the plans. So when you say the obtain copy of the letter of financial support, the first point, you have to state whether the confirming assess whether the confirming party has the financial capacity to support the entity as and when it is required funding or financial support. So that is something you need to update in the first point, right? These are some of the audit procedures. You don't want to write all that. So what is relevant based on your scenario, what is the based on the scenario that is given in the exam, and write about 4 to 5, so you will get the full marks, right? So that is very important. Now auditor's conclusion. So the third one, see, first one, to obtain sufficient appropriate audit evidence regarding the appropriateness of management use of going concern assumption in the preparation of the financial statement. To conclude, based on the audit evidence obtained, whether material uncertainty relate to events or conditions that may cause significant doubt on the entity's ability to continue as a going concern. To report in accordance with this ISA. This ISA mean ISA 570 revised, right? The auditor shall evaluate whether sufficient appropriate audit evidence has been obtained regarding or and shall conclude on the appropriateness of management use of going concern basis of accounting in the preparation of the financial statement. That is auditor's judgment. Let's say there are events or conditions and management has prepared the going concern assessment and they have concluded, despite having these events or conditions which may cause significant doubt on the entity's ability to continue as a going concern, still the use of going concern assumption is appropriate. That is what Sri Lankan Airlines has done. It is making persistent losses, net current liability position, negative net worth, serious loss of capital situation, all that are there. But despite having the events and or conditions, the Sri Lankan Airlines management has, based on their going concern assessment, they have concluded that the use of going concern assumption is appropriate, which means they continue to prepare the financial statement on the basis the entity is a going concern. So based on the sufficient appropriate audit evidence, the auditor will conclude yes, I agree with management assessment or management conclusion. Or else the auditor would say, I would not agree or I disagree. If the management state that yes, still the use of going concern assessment is appropriate, management the auditor would say the use of going concern assumption is inappropriate, right? So auditor has to obtain sufficient appropriate audit evidence in order to form a conclusion on the appropriateness of management use of going concern basis of accounting in the preparation of the financial statement. Based on the audit evidence obtained, sufficient appropriate audit evidence obtained, the auditor shall conclude whether in the auditor's judgment a material uncertainty exists related to events or conditions that individually or collectively may cause significant doubt on the entity ability to continue as a going concern. A material uncertainty exists when the magnitude of its potential impact and likelihood of occurrence is such that, in the auditor's judgment, appropriate disclosure of the nature and implication of the uncertainty is necessary. When auditor making that conclusion, he has to consider whether a material uncertainty exists related to events or condition individually or collectively that may cause significant doubt on the entity ability to continue as a going concern. Material. What is material uncertainty? A material uncertainty is one relating to events or conditions that may cause significant doubt on the entity ability to continue as a going concern, that may therefore indicate that it may be unable to realize its assets and discharge its liabilities in the normal course of business. So having a material uncertainty doesn't mean that the management use of going concern assumption is inappropriate. Now, in the case of Sri Lankan Airlines, there are events or conditions, and Sri Lankan airline management has prepared a going concern assessment, and then auditor has gone through that, and then auditor is in agreement with the management conclusion. So that's why they have basically not qualified or issued any modification in relation to going concern. But on top of that, they have considered, yes, despite having events or conditions, based on the management assessment of going concern, the use of going concern assumption still appropriate, but material uncertainty exists. So I will explain when we discuss the auditor conclusion how this material uncertainty would drive the auditor reporting conclusions, right? Now, these are the different scenarios. I have a summary also I will show you at the end of the lecture. And after the lecture, I will share that with you. Implication for the auditor's report. Now, first one is use of going concern basis of accounting is inappropriate. Use of going concern basis of, that is auditor's conclusions, right? Use of going concern basis of accounting is inappropriate. If the financial statement have been prepared using the going concern basis of accounting, but in the auditor's judgment, management use of going concern basis of accounting in the preparation of financial statement inappropriate. So now there is a disagreement. So you will understand there is a disagreement. There are events or conditions that may cause significant doubt on the entity's ability to going concern, ability to continue as a going concern, and then as required under SLKS 1, management has prepared a going concern assessment and they have concluded use of going concern assumption is appropriate in preparing the financial statement despite these events or conditions. But based on the auditor's work, based on the sufficient appropriate audit evidence auditor obtained, his conclusion is management use of going mean auditor has concluded that management use of the going concern basis of accounting in the preparation of the financial statement inappropriate. There is a disagreement in this sort of a situation. Auditor has to express an adverse opinion. So that is the first one. Now the second scenario, if the financial statements are prepared on another basis, that means events or conditions have been identified and management has prepared an assessment of going concern. They also have concluded that use of going concern assumption is inappropriate. Now there is no disagreement. Management has decided use of going concern assumption is inappropriate. Auditor also in the same conclusion. If the financial statements are prepared on another basis, that is breakup basis or liquidation basis of accounting, then the auditor may be able to express an unmodified opinion. Now you will understand that management has done the going concern assessment and they conclude that use of going concern assumption is inappropriate and they don't prepare the financial statement on the basis the entities are going concern. And auditor is also in the same opinion. So there is no problem. There is no disagreement. That means they can still express an unmodified opinion. Unmodified opinion. What is unmodified opinion? Financial statements are prepared in all material respect in accordance with the applicable financial reporting framework or financial statements provide true and fair view. Now, going concern assumption is inappropriate, which is the conclusion of the management, and the auditor also concur with that. Both parties agree that in preparing the financial statement, you cannot use the going concern basis. In other way, other way you have to prepare the financial statement on another basis. That is, we call breakup basis or liquidation basis. So in this situation, auditor can issue an unmodified opinion on those financial statements, provided there is adequate disclosure therein under the basis of preparation. So I will show you that sort of accounts that actually I got downloaded that one. Now this is a company independent auditors report on the members of Big Ben Tobacco Company. Now opinion. It says unmodified opinion. We have audited whatever. In our opinion, the financial statement give a true and fair view of the state of the company affairs as at 31st December and of its profit for the year end have been properly prepared in accordance with UK accounting standard, have been prepared in accordance with the requirement of the Companies Act of UK. Right? So let's go back to this. I will show you the balance part. Right? So in that what has happened, this particular company, the management also has decided that use of basis is in during 2014 and 15 operations were wound down and the Congo branch has been in the process of closing. Management intends to liquidate the business in the foreseeable future. As a result, the financial statement have been prepared on a basis other than the going concern basis. Right? Other than concern basis. So this is basically in the basis of preparation. Now, if you go back to our presentation, now see what is going concern are prepared on a going concern basis. unless management either intends to liquidate the entity or cease operation or has no realistic alternative but to do so. Now, see here, what is even intend to liquidate the business in the foreseeable future, then you cannot use the going concern basis. So the management has concluded that the use of going concern assumption in preparing the financial statement is inappropriate. And auditor also conclude on that. That's why they have expressed. See, they have expressed an unmodified opinion. What is an unmodified opinion? The financial statement provided true and fair view of state of affairs as at the given date and its the results of operations. Right? Now, what it says, if the financial statements are prepared on another basis, not on the going concern basis, then the auditor may be able to express an unmodified opinion on those financial statements, provided there is adequate disclosure therein. Now, where the disclosure is provided, basis of preparation, about the basis of accounting on which the financial statements are prepared. Now, in this the account set which I showed you all, that they have explained why they have used another basis other than the going concern basis, but may consider to include an emphasis of matter paragraph in accordance with ISA 706 revised in the auditor's report to draw the user's attention to that alternative basis of accounting and the reasons for its use. Now, first of all, we should know what is when you all do the auditor reporting standard, probably we will discuss. But for the otherwise, you will see what is an emphasis of matter paragraph. Now, in this account set, there is an emphasis of matter paragraph. So they have given, you see, emphasis of matter, non-going concern basis of preparation. We draw attention to the disclosure made in the note 1. Now, what is the note 1? We will go back to what is note 1. This is in the note 1. It explains that why the basis of preparation and why they have considered using another basis other than the going concern basis, right? So we'll go to that. We draw attention to the disclosure made in note 1 to the financial statement, which explain that the financial statements are now not being prepared on the going concern basis for the reasons set out in that note. Our opinion is not modified in respect of this matter. Now you will consider what is an emphasis of matter paragraph. Now there are two matter paragraphs which we use to include in the independent auditor's report. First one is emphasis of matter paragraph. Other one is other matter paragraph. Now, what is emphasis of matter paragraph? In the auditor's report, auditor include an emphasis of matter paragraph. In the account set which I showed you now, there is an emphasis of matter paragraph. Now, what it says is, we draw your attention to the disclosure made in note 1 to the financial statement, which explain that the financial statements are now not being prepared on the going concern basis for the reasons set out in the note, right? Now, first, what is an emphasis of matter? An emphasis of matter paragraph is used to draw users' attention to a matter or matter that is appropriately presented or disclosed in the financial statement because it is fundamental to the user's understanding of the financial statement. What is an emphasis on matter paragraph? What is the purpose of giving an emphasis on matter paragraph? To draw users' attention to a matter or matters that is or that are appropriately presented. There is no issue with that. To draw users' attention to a matter or matters that is, or that are appropriately presented or disclosed in the financial statement because it is so fundamental to the user's understanding of the financial statement. Are you all clear? The purpose of giving an emphasis of matter paragraph in the independent auditor's report is to draw users' attention to a matter or matters that is or that are appropriately presented or disclosed in the financial statement. Appropriately presented or disclosed mean there is no problem, but it is fundamental to the user's understanding of the financial statement. It is fundamental to the user's understanding of the financial statement. In other words, what the auditor say in an emphasis of matter paragraph, I draw your attention to note 1. You better read it because that is fundamental to the user's understanding of the financial statement. That is what effectively done by this particular auditor. We draw attention to the disclosure made in note 1 to the financial statement, which explain that the financial statements are now not being prepared on the going concern basis for the reason set out in that note. Our opinion is not modified in, which means it is not notification. So this is fundamental to the user's understanding of the financial statement. In other words, these auditors say, you better read the note 1. I emphasize this is fundamental to your understanding of the financial statement. You better read note number 1. That's what the purpose of an emphasis of matter paragraph. What is an emphasis of matter paragraph? Something that is appropriately presented or disclosed in the financial statement. There is no problem, right? That's why the auditors state that our opinion is not modified. But my purpose here is to draw your attention. You better read note 1 to the financial statement that is fundamental to your understanding of the financial statement. Now, if you go to basis of preparation, this note, appropriately presented or disclosed. There is no problem with it. But it is fundamental. Now, this part is fundamental to the user's understanding of the financial statement. Now, you will see they don't have non-current prepare the financial statement on breakup basis. So I hope you are clear with the first concept. Emphasis of matter paragraph. What is the purpose of an emphasis of matter paragraph? To draw users' attention to a matter or matters that is or that are appropriately presented or disclosed in the financial statement because it is so fundamental to the user's understanding of the financial statement. So that is the purpose of an emphasis of matter paragraph. Then the other one is other matter paragraph. The purpose of another matter paragraph to draw users' attention to any matter or matter other than those presented or disclosed in the financial statement. What is the purpose of another matter paragraph? To draw users' attention to any matter or matter other than those presented or disclosed in the financial statement. Right? Give me a minute, right? To draw users' attention to any matter or other matters other than those presented or disclosed in the financial statement, right? So this is basically, it has not been disclosed in the financial statement because there is no reason to disclose. But auditor consider it is important for me to include another matter paragraph in the financial statement to draw users attention. Now, example is this. With that, you will understand. See, this is an example of another matter paragraph. The financial statement of ABC company for the year ended 31 December 2010 were audited by another auditor who expressed an unmodified opinion on those statements on March 31st, 2021. Now, what has happened here? This is the first year of auditing for that particular company auditor. The last year audited accounts have been audited by another auditor, and that person has expressed an unmodified opinion on the last year financial statement. Now, when you prepare the financial statement, you don't want to disclose that. And in the financial statement, there is no reason to disclose that last year audit was conducted by ABC company, this particular auditor, and they expressed an unmodified opinion, and their audit report date was 31st March 2021. There is no reason, right? But why auditor is considering that? What is the purpose of another matter paragraph? To draw users' attention to any matter or matters other than those presented or disclosed in the financial statement. So this is not disclosed in the financial statement, but auditor consider that is important for me to keep the users informed of that. So that is, now what is the difference between emphasis on matter paragraph and other matter paragraph? Emphasis on matter paragraph is given to draw users' attention to a matter or matters that is O that are appropriately presented or disclosed in the financial statement, whereas the purpose of an other matter paragraph is to draw users' attention to any matter or matters other than those presented or disclosed in the financial statement. So these are the some of the examples. The financial statement of ABC company for the year ended 31 December 2020 were audited by another auditor who expressed an unmodified opinion, those statement on 31st March 2021. Another example, the financial statement of ABC company for the year ended 31st March 2021 were audited by another auditor who expressed a qualified opinion. In this case, not an unmodified opinion, but a qualified opinion on 10th October 2020, let's say 2021, on those statements in relation to inability to obtain comfort on existence of inventory. So they are given a qualified opinion. There is a limitation of scope, inability to obtain comfort on the existence of inventory. So this is basically emphasis of matter and other matter paragraph. So let's go to our presentation. I just explain the emphasis of matter and other matter paragraph, right? Now what is where we were? If financial statements are prepared on another basis, that is liquidation basis, then the auditor may be able to express an unmodified opinion on those financial statements, provided there is an adequate disclosure therein about the basis of accounting on which the financial statements are prepared, but may consider to include an emphasis on matter paragraph in accordance with ISA 706 revised in the auditor's report to draw the user's attention to that alternative basis of accounting. So I showed you, a real account set which had an emphasis on matter paragraph, and the financial statements have been prepared not on going concern basis. So now here we discuss two scenarios. Use of going concern basis of accounting is inappropriate. In the first scenario, still management conclude the use of going concern basis of accounting is appropriate, but auditor conclude it is inappropriate. In that case, an adverse opinion. If both auditor and management agree that the use of going concern assumption is inappropriate, then unmodified opinion uh, can be expressed, and auditor may consider to include an emphasis on matter paragraph. Now you know what is an emphasis on matter paragraph is and the purpose of it, right? Now let's move. Adequacy of disclosures when events or conditions have been identified and material uncertainty exists. Now this is if the auditor conclude that management use of going concern basis is appropriate in the circumstances, that means even so conditions have been identified and as required under LKS 1, management has prepared a going concern assessment, and based on the going concern assessment, management has concluded that use of going concern assumption is appropriate despite the events or conditions that may cause significant doubt on the entity's ability to continue as a going concern. Then, based on the sufficient appropriate audit evidence obtained, the auditor conclude that management's use of going concern basis of accounting is appropriate. So they agree. Okay, there are events or conditions, and then you have concluded that use of going concern assumption is appropriate, and we agree with that. But then auditor conclude there is a material uncertainty that exceeds. The auditor shall determine whether, if there is a material uncertainty, then auditor has to consider whether the financial statement adequately disclose the principal events or condition that may cause significant doubt on the entity's ability to continue as a going concern, and management plans to deal with these events or conditions. So that is what effectively Sri Lankan Airlines done. See, going concern note. These are the events or conditions, right? Then they have given the mitigating factors, how they justify the use of going concern assumption is appropriate, right? So they have given all that. An auditor has to conclude whether the adequate disclosures are made in the financial statement. Now you will see the flow. Adequacy of disclosure when events or conditions have been identified and material uncertainty exist. If the auditor conclude that management use of going concern basis is appropriate in the circumstances. Now, what are the circumstances? Events or conditions have been identified. But if the auditor conclude use of going concern assumption is appropriate, but a material uncertainty exists, the auditor shall determine whether the financial statement adequately disclose adequately disclose the principal events or conditions that may cause significant doubt on the entity's ability to continue as a going concern, and management plans to deal with these events and conditions. Now, Sri Lankan Airlines, they had disclosed the events or conditions now, and then the management plans to deal with the events or conditions. Then disclose clearly that there is a material uncertainty related to events or conditions that may cause significant doubt on the entity's ability to continue as a going concern, and therefore it may be unable to realize its assets and discharge its liabilities in the normal course of business. In the normal course of business. Right? If you go back once again to Sri Lankan Airlines, so they have disclosed the events or conditions, right? Now, if I just go to one moment. Right. Let me once again share the screen. Can you all see my screen? Can somebody confirm whether you all can see my screen? Can you all
Yes, sir.
see my screen?
Yes, sir. We can say.
right? So this is material uncertainty exit. The first is the disclosure requirements, right? Now let's go to the reporting conclusion. Now, use of going concern basis of accounting is appropriate, but a material uncertainty exit. So you will see the flow. Events or condition identified. Management has performed the going concern basis of assessment, and then auditor has performed. The auditor also consider the use of going concern assumption is appropriate, but a material uncertainty exceed. Now the requirement is that in that sort of a situation, adequate disclosure to be made in the financial statement. That's why it says the auditor shall determine whether the financial statement adequately disclose the principal events or condition that may cause significant doubt on the entity ability to continue as a going concern, and management plans to deal with these events or condition. Disclose clearly that there is a material uncertainty related to events or condition that may cause significant doubt on the entity ability to continue as a going concern, therefore that it may be unable to realize its assets and discharge its liabilities in the ordinary course of business. Now first one, scenario one. Use of going concern basis of accounting is appropriate, but a material uncertainty exit. Adequate disclosure of material uncertainty is made in the financial statement. First, use of going concern basis of accounting is appropriate, but a material uncertainty exit, and adequate disclosure of material uncertainty is made in the financial statement. Now, what are the conclusion, the implication to the auditor's report? If adequate disclosure about the material uncertainty is made in the financial statement, the auditor shall express an unmodified opinion, and the auditor report shall include a separate section under the heading Material Uncertainty related to going concern. So, what are the implications to the audit report? Auditor can continue to express an unmodified opinion, right? Unmodified opinion, and shall include a separate section under the heading Material Uncertainty related to going concern. What is the purpose of this particular paragraph? Actually, before the revision, now I said ISA 570 was revised along with the auditor reporting standard. Before this revision, this paragraph section under the, now we are giving under the heading Material Uncertainty related to going concern, we used to give under emphasis of matter paragraph heading. But after the revision to ISA 570, along with the auditor reporting standard, we don't use the word emphasis on matter, but we give material uncertainty related to going concern. What is the purpose? To draw attention to the note in the financial statement that discloses the relevant matters. Now, Sri Lankan Airlines has a detailed note, events and condition, and there are plans to deal with the going concern. State that these events or conditions indicate that a material uncertainty exists that may cause significant doubt on the entity's ability to continue as a going concern, and the auditor's opinion is not modified in respect of this matter. This is when under what scenario? Use of events and conditions have been identified. Management has performed a going concern assessment. Management has performed a going concern assessment, and auditor also, and they have concluded that the use of going concern assumption is appropriate despite these events or condition, and auditor has performed the relevant audit procedures and concluded that use of going concern assumption is appropriate but material uncertainty exists. Then next stage for the auditor is to consider whether adequate disclosures have been made in the financial statement. If adequate disclosure of material uncertainty is made in the financial statement, the auditor can express an unmodified opinion, and the auditor's report shall include a separate section under the heading Material Uncertainty related to going concern. What is the purpose of this paragraph? Similar to the purpose of an emphasis on matter paragraph, to draw users' attention to the note in the financial statement that discloses the relevant matters related to going concern. state that these events or conditions indicate that a material uncertainty exists that may cause significant doubt on the entity's ability to continue as a going concern, and that the auditor's opinion is not modified in respect of the matter. Now see the example. Now see opinion. So this is an unmodified opinion. What it says, in our opinion, the company in financial statement present fairly in all material respect the financial position of the company as of 31 December 2016 and its financial performance and its cash flow for the year then ended in accordance with the financial report, international IFRS, right? Basis for opinion, right? Then see, this is that particular paragraph. What is the paragraph name? Material uncertainty related to going concern. Now, this is when use of going concern basis of accounting is appropriate, but a material uncertainty exists. An adequate disclosure of this particular material uncertainty is made in the financial statement. In that case, unmodified opinion, right? Unmodified opinion, and the auditor's report shall include a separate section under the heading material uncertainty related to going concern, right? So this is what we draw attention to note 6 to the financial statement, which indicate that the company incurred a net loss of so much during the year ended 31 December 2016, and as of that day the company current liability is total asset by $106,000. It is a negative net worth. Current liabilities exceed its total assets. It's actually current liabilities exceed its total assets more than the total assets of the company. As stated in note 6 to these events or condition along with the other matters as set forth in note 6 indicate that material uncertainty exists that may cause significant doubt on the company's ability to continue as a going concern. So what is the purpose of this particular paragraph? Draw attention to the note in the financial statement that discloses relevant matter. Now if you go, it refers to note number 6, which indicate that the company incurred a net loss and all these events or conditions at high level is given. That is the first purpose, to draw attention to the note 6, right? Second one, what is state that these events or conditions indicate that a material uncertainty exists that may cause significant doubt on the entity ability to continue as a going concern, and the auditor's opinion is not modified in respect of this matter. That is, as stated in note 6, these events or conditions along with the other matters set forth in note 6 indicate that material uncertainty exists that may cause significant doubt on the entity's ability to continue as a going concern. Our opinion is not modified in respect of this matter. So that is when use of going concern basis of accounting is appropriate, but a material uncertainty exists, and adequate disclosures of the material uncertainty is made in the financial statement. Let's go now the other one. Use of going concern basis of accounting is appropriate, but a material uncertainty exists. The auditor, what has happened? Use of going concern basis of accounting is appropriate. Adequate disclosure of the material uncertainty is not made. In the earlier scenario, is made. Now here is not made, right? What are the implications to the auditor's report? A qualified opinion if disclosures are inadequate, or an adverse opinion if the how do you differentiate between inadequate and omit the disclose? How do you differentiate in this sort of a situation? What is the situation? Use of going concern basis of accounting is appropriate, but material uncertainty exists. Adequate disclosure of material uncertainty is not made in the financial statement. The auditor can express a qualified opinion if the auditor considers disclosures are substantially there, but it is inadequate. In that case, qualified opinion. Then an adverse opinion, disclose or omit the required disclose. So disclose or omit critical disclosure. Now how that decision is made, which one to give, qualified opinion and adverse opinion. Why? Adequate disclosures of the material uncertainty is not made in the financial statement. As required, sufficient appropriate audit evidence regarding the appropriateness of the management use of going concern basis of accounting, but adequate disclosure of material uncertainty is not made in the financial statement. If it is made, what? Unmodified opinion and separate section called material uncertainty related to going concern. So that is what earlier we discussed. Now here not disclosed. What it says, as required by ISA 570 revised, when the auditor has obtained sufficient appropriate audit evidence regarding the appropriateness of the management use of the going concern basis of accounting, but adequate disclosure of a material uncertainty is not made in the financial statement, the auditor has to first assess. See, the auditor has to first assess whether the effect on the financial statement of inadequate disclosure are likely to be material but unlikely to be having a pervasive effect on the financial statement, or it will likely to have both material and pervasive effect on the financial statement. I hope you can remember when we were discussing ISA 250. Can you remember this slide? Those who have attended, they should be able to remember. So first you have to consider there are two situations where you would modify, and when there is a scope limitation and departure from the applicable financial reporting, or when financial statements are materially misstated. To decide on which, there are four types of modifications. If the effect is material but not pervasive, then auditor has to express a qualified opinion. If the effect is both material and pervasive, in the case of a scope limitation, the auditor has to issue a disclaimer of opinion. If the effect is material and pervasive, in the case of departure from applicable financial reporting framework, or when financial statements are, in other words, financial statements are materially misstated, then adverse opinion. So I'm not going to explain in detail. So when you do auditor reporting standard, you will discuss that. But under 250 standard, I explain this process. So those who have not attended that class, they can just refer to that whatever the recording or something. If the use of going concern basis of accounting is appropriate, but a material uncertainty exists, inadequate disclosure of the material answer is not made in the financial statement, so what has to do? So auditor has to issue either qualified opinion and adverse opinion. To decide which one to issue, the auditor has to first assess whether the effect of the financial statement of inadequate disclosures. Why? Adequate disclosure of the material uncertainty is not made in the financial statement. That's why. The auditor has to first assess whether the effect on the financial statement of the inadequate disclosures are likely to be material but unlikely to be having a pervasive effect on the financial statement, or it will likely to have both material and pervasive effect on the financial statement. If the auditor assesses that the effect on the financial statement of the inadequate disclosures are likely to be material but unlikely to be having a perceived effect on the financial statement, then auditor shall express a qualified opinion. So this one. Now when you actually express a qualified opinion, the effect of the inadequate disclosures are considered to be material but not considered to be having a pervasive effect. In that case, a qualified opinion. That's what it says. If the auditor assesses the effect on the financial statement of the inadequate disclosures are likely to be material, but unlikely to be having a pervasive effect on the financial statement, then the auditor shall express a qualified opinion. If the auditor assesses that the effect on the financial statement of the inadequate disclosures are likely to have both material and pervasive effects on the financial statement, the auditor shall express an adverse opinion. So, in other case, when the disclosures omit very critical disclosures, in that case, auditor has assessed the effect of inadequate disclosures are likely to be both material and pervasive. In that case, adverse opinion. When the qualified opinion is issued, auditor consider the effect of inadequate disclosures are likely to be material but unlikely to be having a pervasive effect. In that case, a qualified opinion, right? A qualified opinion. So this what is explained. So this is an example. Qualified opinion. In our opinion, except for the incomplete disclosure of the information referred to in basis for qualified opinion section of our report. The rest is okay. So I write that is qualified opinion. As discussed in note YY, the company's financing arrangement expire and amounts outstanding are payable on 31st December 2016. The company has been unable to conclude on renegotiations to obtain replacement finance. The situation indicates that material uncertainty exit that make a significant doubt on the company's ability to continue as a going concern. The financial statement do not adequately disclose this matter. So this is a qualified opinion, at which point we issue auditor conclude that the effect of inadequate disclosure is likely to be material but unlikely to be having a pervasive effect, right? So this is an adverse opinion. I explain now. The adverse opinion is the right opposite of the unmodified opinion. Now, what is an unmodified opinion? That's the best opinion an entity could receive from its auditors. What is an unmodified opinion? Financial statement provide true and fair. What is an adverse opinion? Financial statement do not provide true and fair view. Right opposite of unmodified opinion is the adverse opinion. Now, in the case of going concern, when we issue the adverse opinion, the use of going concern assumption is appropriate, but a material uncertainty exit and adequate disclosures are not made in the financial statement. Auditor assesses the effect of inadequate disclosures, the effect of inadequate disclosures likely to have both material and pervasive effect. In that case, an adverse opinion. What it says, in our opinion, because of the omission of the information mentioned in the basis of for adverse opinion section of our report, the accompanying financial statement do not present fairly or do not give a true and fair view of the financial position of the company. So that is right opposite of the unmodified opinion. Now, the basis for adverse opinion. Now, in this previous case, we issue a qualified opinion, basis for qualified opinion. Now, here, basis for adverse opinion. The company's financing arrangement expired, then the amount outstanding was payable on December 31st, 2016. The company is unable to conclude on all that. So it says that the financial statement do not adequately disclose. So you will understand up to now what we discuss. Use of going concern basis of account is inappropriate. But if management continue to prepare the financial statement on the basis of a going concern, then adverse opinion. And if use of going concern is inappropriate, and management is preparing the financial statement on another basis, liquidation or breakup basis, unmodified opinion, and auditor may consider include an emphasis of matter paragraph. You understand what is the purpose of an emphasis of matter paragraph. Then adequacy of disclosure when events or conditions have been identified. use of going concern basis of accounting is appropriate, but the material uncertainty exceed. Inadequate disclosure of the material uncertainty is made in the financial statement. Modified opinion and the material uncertainty related to going concern. What is the purpose of that paragraph? Which is similar to an emphasis on matter paragraph. Draw attention to the note in the financial statement that discloses the relevant matters and state that these events or conditions indicate that a material uncertainty exists that may cause significant doubt on the entity's ability to continue as a going concern, and that the auditor's opinion is not modified in respect of the matter. Then what we just discussed, use of going concern basis of accounting is appropriate, but a material uncertainty exists. Adequate disclosure of material uncertainty is not made in the financial statement. If the auditor assesses the effect of inadequate disclosures are considered to be material but not pervasive, then a qualified opinion. If auditor assesses the effect of inadequate disclosures likely to be having both material and pervasive effect, then an adverse opinion, right? I hope you all are clear with what we discussed, right? That is what it's right. Adequacy of disclosures when events or conditions have been identified but no material uncertainty exists. Now, what is that? Now, this is basically events or conditions have been identified and management has performed the going concern assessment, and they have concluded that use of going concern assumption is appropriate, with which the auditor also in agreement, and at the same time auditor has not concluded that there is a material uncertainty. In the previous scenario, but use of going concern basis of accounting is appropriate, but material uncertainty exists. Now, what is this? Adequacy of disclosures when events or conditions have been identified, but no material uncertainty exists. Now, this could happen to a company like new company. In the when you incorporate a company, generally first 1 or 2 years or 3 years they make losses. But when you have losses, they are considered as events or conditions. But based on their business plan and based on commencement of their operation at full scale, the auditor may consider, despite having events or conditions, the management use of going concern assumption is appropriate, but and at the same time there is no material answer. This is for a new company. Let's say we have just started operation. Initially, generally you tend to incur losses, but when you start your operation in full scale, you are generally going to make profit. And then based on the auditor's assessment of going concern assessment prepared by the management, auditor also conclude that use of going concern assumption is appropriate and no material uncertainty exists. Now, this is kind of a rare situation could happen. Let's say after the balance sheet date, they have won a significant contract. So the last year they have incurred losses and there are other events or conditions. But when they do the going concern assessment, you understand that they have won a significant contract. As a result, definitely the entity is going to be profitable. So events or conditions have been identified. Management has prepared the going concern assumption, and they have concluded that use of going concern assumption is appropriate. Auditor also conclude on the same thing, which means auditor also conclude use of going concern assumption is appropriate, and at the same time auditor conclude that there is no material uncertainty. In that case, the implication to the auditor's report. If events or conditions have been identified that may cause significant doubt on the entity's ability to continue as a going concern, but based on the audit evidence obtained, the auditor conclude that no material uncertainty exists. The auditor shall evaluate whether, in view of the requirement of the applicable financial reporting framework, the financial statement provide adequate disclosure about these events or conditions. Now, this sort of a situation is very rare and considered as a close call. This close call, generally when you have events or conditions, you generally end up with a material uncertainty. But in very rare circumstances, auditor may conclude that no material uncertainty exists in the event of a new company, or they have subsequently won a significant contract which would generate, definitely going to generate profit. That is, this sort of a situation is called close call. That's what it says. This close call can be disclosed in line with ISO 701. What is ISO 701? Reporting key audit matters in the independent auditors report. Key audit matters are to be disclosed in the listed companies audit report, right? So that's what it says. This sort of a situation will generally be considered as a going concern. Why? Generally be considered as a key audit matters. Why? This is because while the auditor may conclude that no material uncertainty exists, they may determine that one or more matters relating to this conclusions are key audit matters. Example include substantial operating losses, available borrowing facilities, and possible debt refinancing or restructuring, or non-compliance with loan agreements or covenants and related mitigating factors. In summary, if a confirmed material exit, it must be disclosed in accordance with ISO 570. That's what we disclose. If there is a material uncertainty, then that's what. Material uncertainty, adequate disclosure of the material uncertainty is made in the financial statement. Then the other one is adequate disclosure of material uncertainty is not made in the financial statement. Now, if the material uncertainty is not there, then ISA 570 doesn't deal with that. That's why it says, in summary, if a confirmed material uncertainty exists, it must be disclosed in accordance with ISA 570. And where there is a close call, what is the close call? Adequacy of disclosures. Basically, what is a close call? Even so, conditions are being identified. Use of going concern assumption is appropriate, but no material uncertainty exists. That is a close call. That's what it says. Where there is a close call over going concern, which has been determined by the auditor to be a CAM, it will be disclosed in line with ISA 701. So, in the situation of a close call, auditor will deal with in accordance with ISA 701. If there is a material uncertainty, then auditor deals with ISA 570, right? The other one is management unwilling to make or extend its assessment. Generally, the management assessment of going concern should cover 12 months from the date of the financial statement. That is called foreseeable future. Generally, foreseeable future means 12 months window. If management is unwilling to make or extend its assessment when requested to do so by the auditor shall consider the implication to the auditor's report. In certain circumstances, the auditor may believe it is necessary to request management to make or extend its assessment. If they say they have done only for 6 months, you may require, auditor will ask to extend it for 12 months period. If the management is unwilling to do so, a qualified opinion or a disclaimer of opinion in the auditor's report may be appropriate, because it may not be possible for the auditor to obtain sufficient appropriate audit evidence regarding the management use of going concern basis of accounting in the preparation of the financial statement, such as audit evidence regarding the existence of plans management has put in place, or the existence of other mitigating factors. Even the fact that the use of going concern basis of accounting is likely to be material and pervasive, finances may more likely to that a disclaimer of opinion will be appropriate in the circumstances, right? So just for you to show you the summary, I will share this slide with you all. Now this is to summarize what I explained. Events or conditions identified, no. Now in a case company like Dialog or Haley's PLC or John Keel's Holding, there are no reporting in relation to going concern unmodified opinion. Events or condition identified, use of going concern basis is appropriate. First one is yes. First one is yes. events or condition identified, use of based on the management assessment of going concern, use of going concern basis is appropriate. Yes. Material uncertainty exit. Yes. If it is yes. Financial statement disclose events or conditions and management plans to deal with the conditions. Yes. Unmodified opinion AR to include separate section termed as material uncertainty relate to going concern. So this is basically this one. Is it this one? Use of going concern basis of accounting is appropriate, but a material uncertainty exit. Adequate disclosure of material uncertainty is made in the financial statement. But we said unmodified opinion and the auditor's report shall have a separate section under the heading material uncertainty related to going concern. So that is what I just explained. See, events or condition identified, yes. Use of going concern basis of accounting is appropriate, yes. Then the next question is material uncertainty exit, yes. Then when there is a material uncertainty, a financial statement should have the relevant disclosures. Financial statement disclose events or condition and management plans to deal with the condition, yes. Unmodified opinion AR to include the separate section term material uncertainty related to going concern. Now we come the same path here. Events or condition identify, yes. Use of going concern basis is appropriate, yes. Material uncertainty exit, yes. Financial statement disclose events or condition and management plans to deal with the condition, no. Then this is the situation. Adequate disclosure of the material uncertainty is not made. If the effect of the inadequate disclosure is material but not pervasive, then qualified opinion. If the effect of inadequate disclosure considered to be having both material and pervasive effect, then an then an adverse opinion. So that's what it says. The two scenarios. You see, disclosure in the financial statement inadequate, which means the effect of inadequate disclosures are considered to be material but not pervasive, then qualified opinion. Then disclosure in the financial statement omit critical information, which means the auditor assesses the effect of inadequate disclosures are considered to be having both material and pervasive effect. In that case, an adverse opinion. Now we'll come here. Events or condition identified. Yes. Use of going concern basis is appropriate, yes. Material uncertainty exit, no. Then unmodified opinion, this situation is called as close call, may be disclosed as a CAM. Financial statement nevertheless include disclosure. What is that? This situation. Adequacy of disclosure. Events or conditions have been identified, but no material uncertainty exit. This situation. If events or conditions have been identified that may cause significant doubt on the entity ability to continue as a going concern, but based on the audit evidence obtained, the auditor conclude that no material uncertainty exists, the auditor shall evaluate whether in view of the requirement of the applicable financial reporting framework, the financial statement provide adequate disclosures about these events or conditions. This close call. The situation is called close call, right? So that's what it is, right? Unmodified opinion, the situation is called as a close call and may be disclosed as a CAM under ISA 701. Now let's go to the left-hand side. Events or condition identified. Use of going concern basis is appropriate. No. Have the financial statement been prepared on the basis of a going concern? No. Prepared on an alternative basis, liquidation basis or breakup basis. Unmodified opinion, provided the financial statement contain the necessary disclosure, the auditor may consider it appropriate to include an emphasis of matter paragraph in the financial statement to draw users' attention to the basis of accounting. This is what we discussed, the first one. This one. First one. This one. If the financial use of going concern basis of accounting is inappropriate, if financial statements are prepared on another basis, then the auditor may be able to express an unmodified opinion on those financial statements, provided there is an adequate disclosure therein about the basis of accounting on which the financial statements are prepared, but may consider to include an emphasis of matter paragraph in accordance with ISA 706 revised in the auditor's report to draw the user's attention to that alternative basis of accounting. So that's what effectively provide here. What is that? Even so, condition identify yes, use of going concern basis is appropriate. No, have the financial statement continue to prepare on the basis of a going concern? No. Then there is no disagreement. The audit also conclude that the use of going concern assumption is inappropriate. Management also consider inappropriate and they prepare the financial statement on an alternative basis, breakup basis or liquidation basis. Then unmodified opinion, provided the financial statement contain the necessary disclosure. The auditor may consider it appropriate to include an emphasis on matter paragraph in financial statement to draw users' attention to the basis of account. Right? Then even so conditions identify use of going concern basis is appropriate. No. Have the financial statement been prepared on the basis of a going concern? Yes. Now there is a disagreement. Auditor says no. Auditor state that it is inappropriate. Management consider it is appropriate. Then adverse opinion. So that is what the first one we discuss. See, use of going concern basis of accounting is appropriate if the financial statement have been prepared using the going concern basis of accounting, but in the auditor's judgment, the management use of going concern basis of accounting in the preparation of the financial statement is inappropriate. The auditor shall express an adverse opinion. So there is a disagreement. Regardless of whether or not the financial statement include disclosure of the inappropriateness of the management use of going concern basis of accounting. So you will see that this is in summary the auditor reporting conclusion. So in the exam you will be asked different scenarios. So now I'm going to show you the scenarios. So you have to be familiar with these things, right? Now, explain the implication to the independent auditor's report. When the auditor concludes that the use of going concern assumption is appropriate in the circumstance, but material uncertainty exit and adequate disclosures is made in the financial regarding the material uncertainty. Now, this situation, but we have to answer this situation. If the adequate disclosure about the material uncertainty is made in the financial statement, the auditor shall express an unmodified opinion, and the auditor's report shall include a separate section under the heading material uncertainty related to going concern to draw users' attention to the note in the financial statement that disclose the relevant matters and state that these events or conditions indicate that a material uncertainty exists that may cause significant doubt on the entity's ability to continue as a going concern, and that the auditor's opinion is not modified in respect of this matter. If you write this, it will carry 6 marks, right? So that is the first one. Explain the implication to the independent auditor's report when the auditor concludes that use of going concern assumption is appropriate in the circumstances, but a material uncertainty exit and adequate disclosure is not made in the not made regarding the material uncertainty in the financial statement. Now this one. So you have to explain this part. The auditor has to assess. Now, if the auditor assesses the effect of the financial statement of the inadequate disclosures are likely to be material but unlikely to be having a pervasive effect on the financial statement, then a qualified opinion. If auditor assesses The effect of the inadequate disclosures are likely to have both material and pervasive effect on the financial statement. Then the auditor shall express an adverse opinion. Right? Sorry. Explain the implication to the independent auditor's report when the auditor concludes that use of going concern assumption is inappropriate in the circumstance, but management continue to apply the going concern basis in preparing the financial statement. I hope you can remember this. The first one, use of going concern basis of accounting is inappropriate. If the financial statement have been prepared using the going concern basis of accounting, but in the auditor's judgment, based on the sufficient appropriate audit evidence obtained, if auditor concludes that management use of going concern basis of accounting in the preparation of the financial statement is inappropriate, the auditor shall express an adverse opinion, regardless of whether or not the financial statement include disclosure of the inappropriate of the management use of going concern basis of accounting. So that is what it says. Now what does the question says? Explain the implication to the independent auditor's report. When the auditor concludes that the use of going concern assumption is inappropriate in the circumstances, but management continue to apply the going concern basis in preparing the financial statement. In that case, adverse opinion. The first one, what? Unmodified opinion, but separate section called material uncertainty related to the going concern. The second one, depending on the, if it is the effect of under inadequate disclosure is material but not pervasive, then qualified opinion. If it is both material and pervasive, adverse. In this situation, adverse opinion. Then describe key audit procedures the audit team should perform in assessing whether the entity is a going concern or not. This one. You have to consider what is relevant based on the given scenario and write about 4 to 5. That is sub maximum. Don't try to type 10, because this is a computer based exam. If you try to type all 10, then it would take long time, because this sort of a question will carry about 6 to 7 marks, right? Then list 5 potential indicators or events or conditions that may cause the doubt on the entity ability to continue as a going concern based on the facts given in a simple scenario. So generally, in these will be there. Net liability or net current liability position. Just we have to write list down. Persistent losses, net current liability position, negative net worth or net liability position. The loss of key staff without replacement, moving from credit to cash basis by the suppliers. Likewise, now the scenario will have about 8 to 9 what do you call in the events or conditions. You have to write about 4. It will carry 4 marks. You have to give only 4 events or conditions, right? Don't type more, right? So familiar, right? So, and I will share with uh, Miss Natasha this particular what do you call this summary slide. So that is very useful. You need to link from this summary to the presentation, right? It covers all more all these scenarios which we discuss, right? So you need to be familiar with this summary sheet and then to link. So it's very important that you understand the thought process when it comes to going concern, and then uh, the implication to the auditor's report. So these are some practice questions. So I will share this slide with Natasha. Are there any questions before? I'm not going to discuss this one, ISA 550, but I will give you. You can go through this basically uh, the slideshow, and then I will give you 2 potential questions with along with the answers. Right? Are there any questions before I conclude on that? Are there any questions? If not, basically I can just show you the presentation. It's very much self-explanatory, this particular standard, ISA 550, right? So basically, so ISA 550 related standard. Now, when it comes to the transaction with related parties, uh, if the transaction are in the no ordinary course of business, such transaction will not carry higher level of risk of material risk. If the transaction with related parties are not in the ordinary course of business, then such transaction will carry higher risk of material mistake. The issue with the related party transaction is the related party transaction and relationships operate with extensive and complex range of relationships and structures. And at the same time, the entity systems are not sufficient or having the capacity to identify and summarize transaction and balances with regard to the transaction carried out with its related parties. Generally, the transaction with related parties are considered to be carried out on not on market terms, or in other words, under abnormal market terms. So that is why in Sri Lanka, we have transfer pricing regulations. Transfer pricing regulations. Because there is always expectation that if the related party transactions are carried out in line with the market, in the ordinary course of business, it is similar to a transaction carried out with a third party. There is no risk of material misstatement. But generally, the transaction with related parties are considered to be having higher risk of material misstatement because the extensive and a complex range of relationships and structure, ineffective information systems in the organization to identify or to summarize transaction and balances. Then generally transaction with related parties are carried out at abnormal low market terms, right? So, so I'm not going to discuss this in detail, but I will give you all two questions with discuss why related party transaction give rise to higher risk of material misstatement of the financial statement than with the transaction with unrelated parties. Related parties may operate through an extensive and complex range of relationships and structures with the corresponding party transactions. Information systems may be ineffective at identifying or summarizing transaction, outstanding balance between the entity and its related parties. Related party transaction may be conducted under may not be conducted under normal market and conditions, which means not in the ordinary course of business. The other question is understanding the control environment, including internal control that is relevant to identify and assess the risk of material misstatement associated with related party relationships and transaction. However, in some organizations, controls over related party relationships and transactions are deficient or non-existent for a number of reasons. State the reasons. Now, this is basically this slide. This one. Reasons for deficiency of controls over related party relationships and transactions. Generally, why? The low importance attached by management to identifying and disclosing related party relationships and transactions. The lack of appropriate oversight by those charged with governance on related party transactions. An intentional disregard for such controls because related party uh, disclosures may reveal information that management consider sensitive. For example, the existence of transaction involving family members of management. Then the absence of disclosure requirement under the applicable financial reporting framework. In Sri Lanka, we have LKS 24, which stipulate the disclosure requirement and insufficient understanding by management of the related party requirement of the applicable financial reporting framework. So these are some of the potential questions with the answers I have given. So please refer to the presentation slide and then be familiar with these two questions. That is very important. And if there are any, it's very self-explanatory, so you can basically go through and get the relevant understanding, right? Uh, so this is what I have to cover today. Are there any questions, particularly with regard to concern, or any specific questions related to ISA 550? If somebody has gone through the presentation slide, basically presentation slides were with you for some time because it was released some time back. So I will share this one. Plus, there is another presentation slide. I don't know whether I shared or not. Why there is a presumption that there are fraud risk in relation to revenue recognitions. So I will share that presentation slides as well. Before I conclude, are there any questions which all need my clarification? If not, we can basically conclude. So this will be the last lecture I would be doing for this semester. And I take this opportunity, thanks. So today the participation is very low, probably due to a Sunday. They may be having other classes as well. But I asked them to refer to the recording. The going concern standard would definitely carry at least close to 50, 10 to at least 12 marks or more. So your understanding of the going concern standard, and particularly the implication to the auditor reporting, are very important as far as your exam is concerned. So are there any questions? If you have any question, either you can ask or send a chat message to me. I will clarify. If not, we can basically conclude. Then I will share the going concern report in summary slide, plus the 2 3 slides relate to why the auditor should presume with a rebuttable presumption there are risk of fraud when it comes to revenue recognition. There are 5 reasons we discussed. Management is under pressure to achieve revenue target. There is incentive oppression, high volume of transaction. Revenue recognition could be judgmental. Revenue recognition could be complex. In certain industries like retail sector, the the substantial portion of revenue comes from cash sales, and there could be theft of cash. And to hide that, conceal that, there could be manipulations when it comes to revenue recognition. These are the at high level 5 reasons, and then you can rebut. There are, for certain companies, there are no fraud risk in revenue recognition under 2 circumstances. The company has a simple revenue stream and low volume of transactions. So that there are slides. So that sort of that question carry about 10 or 12 marks. So are there any questions before I conclude? If there are anything, either you can ask or send a chat message. If not, we can basically conclude the lecture. I will give you 30 seconds. Please raise if you have any question.